Hi, I'm Robert Sill. I head up office investments. The year has started off to a very fast pace. Very similar themes to last year. Lots of capital. Domestic capital, we have the REITs, the institutions, the super funds, the privates, mixed in with a lot of offshore interest. Australia continues to be a very attractive investment destination, despite pretty average leasing conditions.
Thanks, Rob. While it's important to not draw too many conclusions from quarterly statistics, investors will have taken notice of the Q1 numbers we released. Those numbers showed signs of stabilisation in the physical markets of both Sydney and Melbourne. Sublease availability in the Sydney CBD is 1.3% of total stock. To put that figure in context, in New York, we're seeing 1.9% of total stock available as sublease and 2.3% in Chicago. In Melbourne, vacancy tightened to 10.4%, which makes Melbourne the tightest of the CBD markets that we monitor.
It's interesting with the capital. In Brisbane and Perth, the resource-based markets, these investors are starting to turn away. They're very much focused just on Sydney and Melbourne, the safe havens in terms of Australia as a place to put your money. But all this capital's coming in together. They're looking for very similar opportunities, well-leased, new office buildings. But with the lack of stock coming through, they're putting in question what's next to buy. So this year we've started off with the process of Westpac Place, which attracted a lot of offshore investment. Lot size around $450 million for a 50% interest, and we're close to exchanging contracts. We're about to launch 52 Martin Place, which will test really the pricing of the market. It's probably one of the best investments that I've seen in my career. A $500 million office building sitting on Martin Place with a 32-year lease WALE. An incredible piece of real estate to test how aggressive these parties are going to be.
Rob, in the residential sector, we're seeing an increasing acceptance of high-density living, the attraction of the level of amenity in the Sydney CBD, and a desire to live in close proximity to work or educational facilities. However, there's a shortage of sites in Sydney. As a result, a number of older style office buildings in close proximity to Hyde Park and Chinatown have been acquired by residential developers for conversion to residential stock. We see this as a positive for the Sydney CBD office market, and over the next 5 years, we project that almost 8% of the Sydney market will be withdrawn. Ultimately, this will exert downward pressure on vacancy rates over the medium term.
Well, the other great news is the fact that a lot of these office buildings are selling to these residential developers at prices of 15 to 20% above their commercial value. This is giving a huge amount of incentive to these office owners that are facing big incentives, long letting up periods, and a change of use means that there's profit finally for some of these owners. This is largely driven by the appetite by the Asian developers. The Chinese have a huge appetite to buy development sites here. They want people out of China coming down here and buying apartments. Our government is allowing that to happen. Other governments, such as the Canadian government, is not letting it happen. The Singaporeans are coming here because in their own markets, once they develop the apartment buildings, people are having to pay 17% stamp duty. So right now in Australia, we're seeing a lot of Asian interest for this product. We're seeing a lot of deals happening, we're seeing new players come in. We're seeing a lot of the Australian land bankers that are holding these sites actually saying, let's reap some of that development profit by selling early. We see this year is going to be another very strong year of investment activity. We'll see our REITs buying. We'll see some of the REITs actually selling at big profits to the offshore investors. So going forward, there's a lot of hope that the leasing markets will recover, and they'll recover in the short term to justify some of this tight pricing that will be paid during the year. So we're looking forward to the next update when we'll be able to share more details on the sale of Westpac Place and 52 Martin Place and see whether that magic 6% yield has been broken. So thank you for your time today. We'll see you soon.